For a long, long time, finance looked at companies from the outside in. The big idea was that efficient markets did all the work, pricing risk and allocating capital. But then, a total revolution happened, a complete shift in perspective. So in this explainer, we're going to crack open the black box of the modern firm and see how capital, power, and risk are really controlled from the inside. All right, here's our game plan. We'll start with how finance used to see the world almost like a perfect, frictionless machine. Then we'll dig into the core conflict that sits right at the heart of pretty much every big company. We'll see how that one conflict completely changed how we think about what a firm even is. After that, we'll look at the imperfect tools people use to manage all that tension. And finally, we'll zoom out and see how these tiny internal decisions can actually ripple outward and shake the entire financial system. So, to really appreciate just how big this change in thinking was, we have to start with the old idea. It was elegant, it was powerful, but it turns out it was also incomplete. And this was the question that started it all. If markets are so smart and so efficient, does it really make a difference how a company pays for things? Does that specific mix of debt and equity, what we call its capital structure, actually change the fundamental value of the business? And the first answer to that question was incredibly elegant. It was basically, no, it doesn't matter at all. The theory said that a company's value comes from its assets, its factories, its ideas, and how you finance those assets. Well, that's just carving up the same pie in different ways. You're just reallocating risk among investors, and hey, they could do that themselves by borrowing or lending on their own. Yeah, but the real world is messy, right? It's not frictionless. You've got taxes. You've got the very real, very painful costs of going bankrupt. And critically, you have the fact that the people running the company and the people who own it, well, they don't have the same information, and they definitely don't always have the same goals. And it's right there, in those gaps, those frictions, that a firm's financing choices suddenly become one of the most important decisions it can ever make. And it turns out the biggest friction of them all isn't some external thing like taxes. Nope, it's built right into the DNA of the modern company. Just think about it for a second. The people who own a big company, the shareholders, they aren't the same people running it day to day. You've got shareholders who provide the cash, and then you've got a whole class of professional managers who are making all the decisions. Now, this setup lets companies get huge and specialized, but it also creates a fundamental, built-in conflict. And this conflict has a name. It's called the agency problem. It's the tension you get anytime a principal, in this case, the shareholders, hands over the keys to an agent, the managers, who, well, might just have their own plans and their own priorities. So once you see this agency problem everywhere, you just can't look at a company as a simple black box anymore. You're forced to pop the hood and deconstruct the whole thing. Now, here's the really crucial point. This conflict isn't free. It creates what we call agency costs. And these aren't fines or penalties. They are the unavoidable structural price you pay for this whole setup. The cost of keeping an eye on managers, designing complicated contracts to keep them motivated, and just accepting that their goals and your goals will never be perfectly aligned. And believe me, these costs aren't just some abstract theory. They show up in very real ways. You might have a manager who's obsessed with empire building, making the company bigger and bigger, even if it's not more profitable. Or maybe they get cautious and pass on a risky but brilliant project because they're worried about their job. Or, they just enjoy the private perks and prestige that don't really do anything for the shareholders. This all leads to a really profound shift in how we think. The firm isn't this one single thing anymore. Instead, it's a nexus of contracts. It's basically a messy, complex web of relationships between shareholders, managers, employees, lenders, all pulling in slightly different directions, all held together by competing incentives. Okay, so if the firm is this complicated web of contracts and potential conflicts, how do you actually manage it? How do you even try to get everyone pulling in the same direction? And this is where it gets really interesting. This is where finance stops being about just raising money and starts being about control. The two main levers you can pull are the company's capital structure, that mix of debt and equity, and how you pay your managers. But, and this is so important, neither one is a silver bullet, not even close. Let's just take debt, for example. On the one hand, debt is an amazing disciplining tool. It forces managers to make those interest payments, which means there's less free cash lying around for them to spend on pet projects. But that very same discipline, it creates fragility. Too much debt can push a company to the brink in a downturn. And it can even create a whole new conflict where shareholders might want to roll the dice on a risky bet to avoid bankruptcy, even if it's bad for the people who loaned them the money. It's the exact same story with compensation. The goal seems simple, right? Align the manager's interests with the shareholders. So the tool seems obvious. Tie their pay to the stock price. But the unintended consequence? Well, managers might get absolutely obsessed with hitting this quarter's numbers while totally neglecting the crucial, hard-to-measure stuff that builds long-term value. Every tool you use creates a new trade-off. All right, let's zoom out now. Because these internal tug-of-wars between discipline and fragility, they don't just stay inside the company. They scale up, and they can have massive consequences for the entire economy. Think about it. When one company takes on a bunch of debt, that's a corporate governance decision. But when thousands of companies all do it at the same time because, say, interest rates are low, the entire system becomes way more leveraged and way more fragile. What started as a tool for micro-level discipline becomes a source of macro-level instability. And this brings us right to the central insight of this whole way of thinking. The old view was that markets allocate capital using prices. Simple. The modern view, capital isn't just allocated, it is controlled through contracts, through incentives, through the power dynamics inside the firm. That's where the really important decisions about risk are made. And this leads to a pretty stunning reversal of an old idea. We used to think of markets as the place where risk was managed and spread around. We now understand that very often firms are where risk is created in the first place. Those internal financing choices, the very things that an earlier generation of economists thought were totally irrelevant, are actually a primary source of the shocks that our entire financial system has to deal with. So this leaves us with a really tough fundamental question. If every solution just creates a new problem, if every attempt at discipline creates a new kind of fragility, how on earth are we supposed to design a financial system that's actually resilient? Realizing that there are no perfect answers, only a series of incredibly complex trade-offs. Well, that isn't the end of the conversation. It's the real beginning.